Is Dubai real estate really a gold mine or a landmine? That's the big question, isn't it? Especially with all the headlines, celebrities, CEOs investing.
Yeah. There's a lot of buzz.
Exactly. So let's try and get past the hype. We're doing a deep dive today, looking at a pretty detailed business case study to, unpack what's really driving the market there.
Right.
Think of this as like your shortcut to understanding the key dynamics. The potential upsides, sure, but also the crucial risks, whether you're actually thinking of investing or just want to understand what's going on.
Mm-hmm. Our goal really is to look under the hood, get past the shiny brochures and into the core fundamentals.
See what's actually supporting these prices.
Exactly. And try to spot any, hidden traps. See if the hype holds up to scrutiny.
Okay, let's start with the attraction then, the gold mine side of the story. What makes Dubai look so good on paper for property investors? The study has some, pretty impressive numbers, starting with growth, capital appreciation.
Yeah, the appreciation rate is definitely compelling right out of the gate. The study points to an average annual growth of 5 to 8% in Dubai.
Which sounds pretty good on its own, but how does that stack up globally?
Well, compare that to London, which is around 4% according to this study. New York, maybe 6%. Mumbai, around 4 to 5%. So Dubai seems to be edging them out.
And over time, that difference adds up.
It really does. The study uses this example like a hypothetical $1 million property bought in 2015. It could potentially have doubled in value by now in Dubai.
Wow.
And that kind of growth is being fueled by, government policies attracting investment, Dubai's image as a stable, desirable place.
It's a safe haven almost.
Sort of, yeah. And then you get to the tax part, which is, a game changer for many.
Right. Zero capital gains tax. That's huge, isn't it?
It's massive. Compare that to, say, 20% you might pay in London or India or the US. That's a huge chunk of your profit you get to keep when you sell.
So it's not just the growth, but keeping more of that growth.
Precisely. It seriously boosts the net return on your investment.
Okay, but what about income while you own the property? Rental yields are often talked about. How does Dubai look there, according to the source?
Again, pretty strong. The numbers in the study suggest that for that same $1 million property, you could be looking at annual rent between, say, $50,000 and $85,000.
Okay, and compared to elsewhere?
Well, London might be more like $30,000 to $45,000. New York, maybe $40,000 to $55,000. And places like Bangalore or Mumbai, perhaps $25,000 to $35,000.
So quite a noticeable difference.
A significant difference, yeah. And then again, the tax situation just sweetens the deal.
Zero tax on that rental income too.
0% in Dubai. Compare that to London or New York, where you could be paying, 20, 30, even 45% tax on rental income, depending on your bracket.
No wonder the study mentions this influx of investors. Europeans, Russians, people from the crypto space, India, looking for luxury places, second homes.
Absolutely. The high yields and zero tax make it incredibly attractive on a spreadsheet.
It almost sounds, a bit too good.
It does present a very compelling financial case. But it's not just about the money, is it? The study also touches on quality of life.
Yeah, that's a good point. The infrastructure aspect.
Right. The study contrasts, the struggle to find a decent two-bedroom place in Mumbai for under, say, 2 crore rupees, or dealing with Delhi's congestion.
Compared to Dubai.
Compared to finding luxury apartments, world-class infrastructure, those high-speed roads, cleaner air, apparently, for potentially a similar price point.
So lifestyle factors play a big role alongside the finances.
They definitely do. Dubai is selling itself as both a high-return investment and a desirable place to actually be, or at least own property.
Okay, so that's the shiny gold mine picture. But the title of the source, gold mine or landmine, suggests we need to look at the other side, the potential risks.
Exactly. We need to dig into those potential downsides. What could possibly go wrong?
Well, the first big risk mentioned is oversupply. Classic real estate concern, right?
Absolutely. It's the perennial fear. Developers get carried away, build too much, and suddenly there aren't enough buyers or renters, leading to falling prices. A correction.
This study mentions examples.
Yeah, it points to those ghost cities in China where developers got into trouble. And of course, the 2008 U.S. housing crash. Prices dropped nearly 30% there because of overbuilding and bad loans.
So it's a real danger. It highlights how crucial that supply-demand balance is.
Critically important. You have to watch how much is being built versus how many people actually need housing.
So how is Dubai doing on that front right now? The study uses a metric, residents per unit built. What's that tell us?
Right, so Dubai's ratio is apparently 2.72. The study suggests anything over 2 is generally healthy, means more residents per new unit being built.
How does that compare?
London's around 2.3, New York 2.55, Mumbai is way higher, like 4.5 to 5, which indicates, well, very strong demand relative to supply there.
So 2.72 in Dubai sounds
Okay.
for now.
It suggests demand is keeping pace, yes. Population growth seems aligned with construction currently, but it's something to watch. If building ramps up massively without population growth following, you could still hit problems down the line.
Makes sense. Okay, another metric mentioned is the housing absorption rate. What's that measure?
That basically looks at how quickly new properties coming onto the market are actually sold or rented out. A high rate means strong demand.
And Dubai's rate?
It's reported at 89%, which is quite high, comparable to New York's 82% or Mumbai's 83%. And interestingly, for luxury properties in Dubai, it's even higher, 95%.
Wow, so the high end is moving very quickly.
Seems like it. Suggests a very strong interest, especially in that luxury segment.
Okay, demand looks solid for now. But what about affordability for, average people living and working there? Is this boom just for the wealthy and international buyers?
That's a really key question. The study looks at the price-to-income ratio, the PIR.
How affordable homes are relative to average incomes.
Exactly. Dubai's PIR is around 6.7. The study interprets this as meaning the market is mainly geared towards medium to high-income earners.
How does that compare globally?
Well, it's quite a bit lower than New York at 14.6 or London at 19.5, and especially Mumbai, which the study puts at over 30.
So, while not cheap, it's comparatively more accessible than London or New York.
Relatively speaking, yes. But a PIR over 6 still raises questions about long-term affordability for everyone and definitely points to the importance of higher earners and foreign money driving things.
And there's another interesting point in the study about rentals versus mortgages in Dubai. It seems different from other big cities.
Yeah, this is quite striking. In many places like Mumbai, London, New York, your monthly mortgage payment is often higher than what you could realistically rent the property out for.
So you're out of pocket each month if you're an investor renting it out.
Often, yes. But the study claims that in Dubai, it can be the other way around. The rental income can actually cover or sometimes even exceed the mortgage payment.
That's a pretty big plus for investors using loans.
A very significant incentive, absolutely. Makes leveraging much more attractive.
But getting those loans could be tricky for some foreign investors, particularly from India.
Yes, that's highlighted as a specific hurdle. Due to Indian regulations, the Foreign Exchange Management Act, or FEMA, Indian residents generally can't take out a home loan in India to buy property in Dubai.
So what are their options?
They either need to pay the full amount up front, in cash effectively, or get a loan from a bank in the UAE, which means tying up potentially a lot more of their own capital.
That's a definite roadblock. Okay, another potential landmine flagged is Dubai's economic link to the U.S. Can you explain that?
Sure. The key thing here is the currency peg. The UAE dirham is pegged to the US dollar.
Meaning their values move together.
Essentially, yes. And historically, as the study points out, this connection matters. When the US housing market crashed hard in 2008,
Dubai felt it.
big time. Dubai's market crashed by around 50%, and it took about 4 years to recover, according to the study.
Ouch. So fast forward to today.
Well, with current concerns about the U.S. economy, high debt, rising interest rates, maybe a recession looming, there's a risk. If the U.S. sneezes,
Dubai could catch a cold.
potentially, global investors might get nervous, pull money out of markets perceived as risky, like Dubai, which could hit property values. Its fortunes aren't entirely independent.
Right. And sticking with foreign investors, specifically from India again, even though Dubai has zero tax locally, there are still tax implications back home, right?
Absolutely critical point. Investors must understand this. Just because Dubai doesn't tax you doesn't mean your home country won't.
So rental income earned in Dubai.
Is generally taxable in India for Indian residents, according to their normal income tax slab, 5%, 10%, up to 30%.
And if they sell the property for a profit.
Same applies. That profit is subject to India's capital gains tax rules. You have to declare that foreign income and property sale.
And not doing so could lead to legal trouble.
Serious trouble. It's not optional. So the zero tax benefit needs that important asterisk.
Okay, so pulling these risks together, the study basically says, look, even with good signs, don't forget the possibility of a bubble or a market correction. It happens everywhere eventually.
Exactly. No market goes up forever in a straight line. Now, the study does mention factors that might soften a potential downturn in Dubai.
Like what?
Things like the strong rental demand we talked about, those high absorption rates, government efforts to maybe regulate supply better now, and that continued foreign investment.
But the risks remain.
The risks, particularly around a potential U.S. recession, and also, crucially, the location of your specific property within Dubai remains significant. Not all areas perform equally.
That leads nicely into the next part of the study, which tries to debunk the idea that only the super rich can actually make money there. It breaks the market down.
Yeah, the segmentation is quite insightful. It identifies 5 main tiers, basically.
Okay, what are they?
You've got ultra luxury, think over $2 million. Then high-end luxury, maybe $800,000 up to $2.7 million. Mid-range, say $300,000 to $800,000. Then affordable housing, under about $270,000. And finally, worker or low-income housing.
And the investment profile is different for each.
Very different. Ultra luxury might see spectacular appreciation. The study mentions crazy numbers like 147% on some properties.
Wow.
But typically, it has the lowest rental yields, maybe 5–7%. These are often, as the study calls them, flex buys. Less about pure investment metrics, more about status, personal use, parking wealth.
Okay, and the high-end luxury.
Better rental yields there, perhaps 6–8%. Still strong appreciation potential. Attracts high-income investors looking for a mix of both.
But it sounds like the mid-range might be the sweet spot for many.
The study suggests it offers potentially the best balance, good growth prospects and solid rental returns. It points to areas like JVC, Dubai Hills, Town Square, Dubai Creek Harbor as key locations for this segment. Fastest growing communities, apparently.
Interesting. And what about the more affordable end?
Affordable housing, so under $270K, places like International City, Dubai South, Dubai Land. Surprisingly good rental yields here, maybe 8–9%. Makes for an easier entry point if you're focused on passive income.
And the worker housing.
That segment can offer the highest yields, often over 10%, in places like Jubilee or Alos. There's constant high demand. But
There's a catch.
yeah, potentially more management headaches and typically lower capital appreciation compared to the other segments.
So the main takeaway here seems to be that profit isn't just for billionaires. It's about strategy.
Absolutely. It really boils down to understanding which segment aligns with your budget, your goals are after growth, income, or both, and your tolerance for risk.
Being strategic about where and what you buy seems key.
Exactly. The study makes it clear that opportunities for good returns can exist across different price points, not just at the very top end, if you do your homework.
Okay, so let's try and sum this up. Our deep dive into this study shows a Dubai market with, well, undeniable appeal. You've got strong potential growth, really attractive rental income possibilities.
And that zero local tax environment, which significantly boosts net returns.
But on the flip side, you absolutely have to weigh the risks. That potential for oversupply is always lurking.
The connection to the U.S. economy, which is looking a bit shaky right now.
The tax obligations you still face back home, which people often forget.
And just the basic fact that real estate markets do correct. They go through cycles.
So it brings us back to that initial question. Given all this, is Dubai a calculated gamble worth taking for the average-ish investor? Or is it really a high-stakes game best left to those with very deep pockets?
It really makes you think, doesn't it? Which factors matter most to you? Your view on the global economy, your need for income versus growth, your comfort level with those specific risks we discussed.
Definitely food for thought. And hopefully this gives you a better framework for thinking about it and encourages you to, keep digging and do your own research if you're seriously considering it.